Monday morning. Pounds at 1.3407, barely changed from the close, but don't let the quiet open fool you. This week, cable faces a trap that will wipe out one entire side of the market, the breakout chasers or the fade sellers. One of them gets liquidated by Friday. This week has one danger zone and one 3 to 5 day opportunity. I'll show you both right now. The weekly chart is screaming strong buy. But the 1 hour chart just printed a strong sell. That clash is the trap. If you don't understand the macro pulse behind it, you'll get chopped to pieces. Stay to the end. I'm giving you 2 Monday scalps and 1 swing trade that can run the next 3 to 5 days, with exact entries, stops, and the invalidation level that resets the entire monthly structure. Let's cut straight to the verdict. My 3 to 5 day structural bias for pound sterling to US dollar is bullish but coiled. We are trending up on the weekly, but the momentum is stalling right at the 1-year high resistance, and we have a huge event on Wednesday. That means we are in a squeeze, not yet a breakout. The bias is to buy dips into weekly support, not chase strength at 1.347 until price proves it can hold above. The single invalidation level that flips this weekly bias is 1.3230. That's the weekly S1 support, and more importantly, it's just below the 100-day moving average. A daily close below 1.3230 kills the bullish structure and opens a fast move toward 1.3108. So write this number down, 1.3230. If that level breaks this week, the whole monthly structure resets to neutral, and the dollar killers lose their edge. Now, here's the micro insight about positioning. The herd came into this week heavily long sterling. Institutional speculative longs are near multi-month highs, betting on the Bank of England holding rates while the Fed stays dovish. But that crowded long is exactly why a liquidity grab below Friday's low is the highest probability Monday move. Markets love to shake out weak hands before the real CPI reaction. We'll use that for our second scalp. Let's build the chart from the top down. Start on the weekly time frame, the macro driver. Price is above every major moving average. The 20-week MA is at 1.3049, the 60-week around 1.3188, and the 200-week MA down near 1.2750. All are sloping higher. That's a textbook uptrend. Weekly RSI is holding above 50, and the MACD, the macro pulse, remains positive. But here's the critical detail. The histogram bars are shrinking for the 3rd consecutive week. That's a hidden, bearish divergence. Price is making higher highs near 1.347, but momentum is not confirming. It doesn't mean sell. It means this week's candle must prove itself. If we get a weekly close above 1.347 with a fresh MACD histogram expansion, the 3 to 5 day swing has legs to 1.3630 and beyond. If the weekly candle prints a doji or rejection wick at 1.347, that divergence becomes a full-blown warning for a correction into next week. Drop to the daily chart. Price is right at 1.3407, sitting above the 20-day MA at 1.3380 and there. 50-day MA at 1.3348. That's supportive. But the daily MACD just barely crossed negative, minus 0.002, a flatlining signal line that shows the trend is taking a breath. The ADX is 23, still below trend strength territory. This tells me the daily chart is compressing. A coil. The Bollinger Bands are narrowing, and that compression always resolves with an explosive move. The 5-day MA at 1.3343 and the 10-day at 1.3354 are just below price, so any dip Monday will likely find buyers there. The key daily resistance is 1.3430, the R1 pivot, and above that 1.3508, but the psychological and technical magnet is 1.347. That's where the 1-year high sits and where stops are building. Now, drop to the 4-hour and 1 hour for Monday's execution. The 4H trend is a clear buy signal. Price is holding above the 4H 20-period MA, and the MACD is curling up from the zero line. That tells me the intraday path of least resistance is higher early this week. But, and this is where Monday's trap lives, the 1-hour chart just flipped to a strong sell. The hourly RSI dipped below 50, The hourly MACD crossed bearish, and price is threatening to break below the hourly 60 MA at 1.3395. This clash is the moneymaker. Here's what most traders will miss until Wednesday. That 1-hour sell signal is not a trend reversal. It's a liquidity purge within a daily and weekly uptrend. The Asian session often fakes lower to stop out week longs before London and New York drive price back up. We've seen this pattern 3 of the last 4 Mondays. The level that matters is 1.3380. That's the daily 20 MA and the bottom of the overnight range. As long as price holds above 1.3380 on a 60-minute closing basis, the Monday scalp buys are valid. Below that, and the purge could extend to the weekly pivot at 1.3308, but I don't expect it unless Wednesday's CPI data shocks. Let's talk cross-asset linkage. The pound is a dollar killer this week, driven by UK gilt yields firming against tumbling US real yields. The 2-year spread is narrowing in sterling's favor. Gold's bid is simultaneously softening the dollar, and that risk-on pulse matters because the S&P 500 futures are holding above their 200-day moving average, keeping a tailwind under cable. If equities wobble, cable will feel it, but so far, the liquidity tide is still flowing. The next signal changes the whole week. Retention bridge at 3 o'clock, if the daily MACD turns positive on any close above 1.3430, the entire compression resolves upward and the swing trade activates early. But if the 1-hour sell pushes price below 1.3380 and we close a 4-hour candle under that level, we delay the breakout and shift to a range-bound 1.3308 to 1.3430 strategy. That's why your Monday entries must be precise. Now let's connect the weekend news and the event calendar to the expected price path. The weekend headline: Pound firms as fading Middle East risk keeps the dollar on the back foot. That's a classic sentiment driver. Less geopolitical fear means less dollar haven demand, and sterling catches a bid. Overnight, we are seeing stable UK gilt yields while US 10-year yield slipped, widening the rate advantage for the pound. That's the narrative web for the next 3 to 5 days, a dollar that's losing its yield support unless the Fed's narrative shifts. The week's calendar has one massive fuse and several secondary charges. Tuesday, we get UK employment data, average earnings and claimant count. Strong wage growth would fuel bow rate hike expectations and give sterling a pre-CPI boost. But Wednesday is the king, US CPI for June. The consensus is around 0.2% month-on-month core. Any print below that and the dollar gets hammered. Cable rips through 1.347 and targets 1.3508, maybe 1.3630 within 48 hours. A hot print above 0.3%, and the dollar killers get killed. Cable reverses hard toward 1.3308, maybe 1.3230. Thursday brings US retail sales and jobless claims, and Friday ends with University of Michigan sentiment and UK retail sales. That means the weekly volatility cluster is Wednesday through Thursday, with Monday and Tuesday being the positioning phased MY1 to 2-week directional lean is bullish while above 1.3308, targeting 1.3630. The exact event that invalidates this lean is a US CPI core MRM print above 0.35% and a subsequent daily close below 1.3308. If that happens, we scrap the bullish swing and look for a deep retracement to 1.3230. Second interaction trigger. Do you think the dollar closes the week below 105 on the DXY? Comment yes or no. I'm tracking. Consensus for the weekly dollar direction. It feeds directly into this cable forecast. Most people skip the planning phase. That's exactly where this week's money is made. Keep watching. I'm going to lay out the only 3 trades you need for pound sterling to US dollar this week. 2 are for Monday's session, 1 with trend, 1 counter noise. The third is the 3 to 5 day swing designed to capture the core CPI move strategy 1, the Monday opening scalp, scalping, high probability. This scalp plays the daily 20 MA support against the 1-hour oversold fakeout. Here's the setup. On Monday's London Open, the 1-hour chart will likely be testing 1.3390 to 1.3385, near the Asian low and right on top of the 20-period MA on the daily. We want to see a 5-minute bullish reclaim. Specifically, entry on a 5-minute candle close above 1.3395. That's the level where the 1-hour sell momentum exhausts and the 4-hour buy trend resumes. Your stop loss goes at 1.3382, just below the overnight swing low and the daily 20 MA. Take profit 1 sits at 1.3420. That's the Asian high and the first intraday resistance. That gives you a 25 pip target with a 13 pip stop, a solid 1 minute and 1.9 seconds risk reward. If price breaks 1.3420 with volume, you can trail to 1.3435. What instantly voids this Monday scalp? A 5-minute candle closed below 1.3380. If that happens, the liquidity grab is extending, and you stand aside for strategy 2, the Monday opening SCALP entry, 1.3395, 5M bullish reclaim, stop loss, 1.3382 take profit 1, 1.3420 risk, reward, 1:1. 9 R invalidation, void if 5M candle closes below 1.3380 strategy 2, the Monday liquidity grab, scalping, counter noise. This is the trapdoor trade. The herd is long, stops are resting below Friday's low at 1.3370. If the Asian session pushes below that level and then snaps back, you have a textbook stop run reversal. Wait for a 15-minute close back above 1.3375 after a fake-out low, say a wick to 1.3355. That's your entry trigger. Place your stop 3 pips below the wick, so if the low was 1.3355, stop at 1.3352. Your target is the nearest liquidity pool. That's exactly the weekly pivot at 1.3405, a fast 30 pip scalp. Risk might be 23 pips, reward 30 pips, so about 1 minute and 1.3 seconds. Not a high ratio, but a high win rate on Monday morning because it catches the market's first mistake. Warning: this requires aggressive execution and instant order placement. If the bounce fails and a 15-minute candle closes below the fake-out low, exit immediately. The flush is real. The Monday liquidity GBP entry, 1.3375, 15M close back above Friday's low after fake-out, stop loss, 1.3352, just below the wick, take profit 1, 1.3405 risk, reward, 1:1.3 R invalidation. Void if 15M candle closes below the wick low. Are you scalping Monday or swinging the week? Comment scalp or swing. Let's see who's built for this market. The swing traders are the ones who will actually capture the 150 pip move if CPI delivers. Strategy 3, the 3 to 5 day swing, trend alignment. This is the main event, the trade that aligns with the weekly strong buy signal and the fundamental catalyst. We are positioning for a breakout above the 1-year high. The trigger condition, a daily close above 1.3470. Not an intraday poke, a daily candle close. That confirms the momentum stall is over and the hidden weekly divergence flips positive. Entry on the daily close above 1.3470. Execute at market at the next day's open or on a retest of 1.3470 as new support. Stop loss is placed below the weekly structural level, specifically at 1.3375, just under the daily 20 MA and the swing low of the breakout week. That gives a 95 pip stop, but it's necessary to survive Wednesday's noise. We have 2 targets. The conservative swing target is 1.3630, the R3 weekly resistance and a measured move of the range from the 1.3308 pivot. That's a 160 pip gain from 1.3470. Risk reward 1 minute and 1.7 seconds. The stretch target for Friday is 1.3750. The 161.8% Fibonacci extension of the last daily swing. Once price reaches halfway to TP1, at 1.3550, move your stop to break even. From there, trail it behind the 4-hour 20 MA. The explicit invalidation for the entire weekly outlook, a daily close below 1.3308. If that happens, the breakout has failed, the weekly divergence is confirmed, and we pivot to shorts targeting 1.3230. Do not hold the swing through that line. A 3 to 5 day SWNG entry, 1.3470, daily close above 1-year high, stop loss. 1.3375 take profit 1. 1.3630 take profit 2. 1.3750 risk, reward. 1:1.7R, to TP1, invalidation. Void if daily close below 1. 3308 never risk more than 1 to 2% per trade. Holding through Wednesday's CPI requires tighter sizing on the swing. I'd go half size until the data prints, then add on confirmation. Stops are non-negotiable. The liquidity grab scalp especially demands a hard stop because the fakeout can accelerate. This is how you survive to trade the next big weekly move. The pound doesn't care about your bias. It only respects levels, so the single most critical level for your entire week is 1.3470. That is the line where the dollar killers either win or the dollar stages a bloody comeback. If we close the daily above 1.3470, the monthly trend flips to strong buy and the entire summer outlook changes. Targets at 1.40 come into view. If we reject it, and CPI punishes the pound, then 1.3308 and 1.3230 are the levels that hold the floor. Friday's wildcard is the combination of UK retail sales and US sentiment. If the swing is in play, Friday could be the acceleration day where we tag 1.3750. I'll have the updated blueprint for you this Sunday, recapping the week and setting up the next 3 to 5 day cycle. That's the video that catches the next big swing early. Here's what I want you to do right now. If you want last week's pound sterling to US dollar recap to see how we nailed the bounce off 1.33, that video is live now. Tap the end screen. It shows the exact setup that led to today's coil. Then hit the bell so Sunday's next week ahead alert lands before the open. You get the levels before the herd. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that define your week. Drop a comment with your Friday close prediction for cable, and I'll see you in the next video. Trade well.